What are some of the risks of owning an investment property?
Yeah, great question. Each year of those 500 properties, only probably one or two end up having damages beyond the security deposit. So that's one risk: will a tenant do enough damage that it costs you more than the deposit?
Welcome to Lawrence Real and Local, Keepin It Real podcast presented to you by the Lawrence Board of Realtors. We're your go-to source for all things real estate in Lawrence, Kansas. I'm Lexie Haskin with Flint Hills Mortgage.
And I'm Campbell Ragan with McGrew Real Estate. Together, we're here to make the journey to home ownership a breeze. Join us as we share insider insights, expert advice, and a dose of fun along the way.
Okay, so we are doing the Lawrence Board of Realtor podcast, Lawrence Real and Local. I am Lexie Haskin with Flint Hills Mortgage.
And I am Campbell Ragan with McGrew Real Estate.
And we are joined with Bryan Hedges with Location Properties and Hedges Real Estate.
That's right. Thanks for having me here.
We are just so thrilled to have you here. And when we were thinking about who to have, I was like, Bryan.
I appreciate that. Yeah. Well, thank you. I appreciate you thinking of me on this topic. And yeah, it's definitely a topic I deal with almost every day. So so hopefully I have some good advice. So.
Yeah, give us some of your background.
I've been with Realty Executives Hedges Real Estate for over 30 years. My dad was with the company for 30 years prior to that. And so, early on in the real estate business, we noticed that buying some investment properties was a good kind of side business to selling real estate. And my dad always had a saying where he would tell the young realtors, you're going to sell some real estate, but once every year or two, buy your own rental property so you can start building your own wealth. And some of them have followed that advice. Some of them are now retired and millionaires. Some of them are multimillionaires because they bought a property every year or two and they kept them, and they've paid those loans off, which would be a good feeling for most investors, and they're still getting the cash flow. So we'll get into some of that a little bit later too. But as we started selling investment property, they started needing management, and so we started offering our own management services, not just for our own properties but for others. And now that's grown, and so. As realtors in our office and even realtors at other agencies around town, they've referred their investors to us after they've helped them find an investment property. And that somehow grew to over 500 properties that we now manage.
Wow.
So just I keep having to buy more or hire more employees to help handle that.
Yeah.
But what we do is, we manage about 500 properties for over 200 different investors. And so most of those investors are kind of on this topic. They own one or two rental properties.
Wonderful.
And so a lot of them really just sold their Lawrence home and they bought another home and then didn't sell their Lawrence home and decided to keep it as a rental.
Yeah.
And then some of them managed it on their own and then eventually hired us as their management company. So
wonderful.
So we kind of mix selling real estate with managing real estate. So,
they go hand in hand for sure.
Sure do.
Yeah.
That's awesome. Yeah.
Yeah, so we'll go ahead and get started. And what are some of the key differences between buying the primary residence and an investment property? Because I know you mentioned that some people keep, the first home. And so can you speak to that a little bit?
Yeah, sure. That's a good point. And I highly recommend buying your own home first. So make sure that you get, first of all, the lenders would tell you, make sure your credit's good so that you can get a good low interest rate on your primary home. And then if you don't already have the 20% down to buy your primary home, you wait till your home goes up in value or pay down your loan. Try to have 20% equity in your current home. And then the next step is to buy that second property. And so a lot of our current investors, like I mentioned, they just kept their first home, moved into another home, rented out the first home, and then now they own two homes. And then not only are they getting the appreciation on the first home, now they're getting the appreciation on the second home while collecting rent on the first home. And so that's one way to do it. Another way to do it is just to save up the down payment, which might be 20 or 25%. A third way is to get a home equity line of credit on your current house. I think some lenders will go up to 95 or 100% of your equity. Early on in my real estate career, a lender walked in our office and offered a HELOC, home equity line of credit, up to 125% of the value of our houses. That was when lenders were a little bit more aggressive. So some of our investors took them up on that, had a line of credit ready to go then, and then they could use that line of credit as their down payment on other investment properties.
Awesome.
I'm glad you brought that up because
yeah.
I was actually going to say something about that too.
Yeah. Some people get a little scared using their home equity as leverage to buy another rental property. So you got to be careful. But if you buy a nice property that's collecting rent, you can make that payment on the first mortgage and technically make the payment on your home equity line of credit. You don't want to do that unless you're buying a nice property that's going to cash flow to help cover both payments. Eventually pay down that home equity line of credit to zero. You want to get that to zero at some point again. Maybe leave it at zero for a while, but keep that line of credit open. And then when you find another good property, then you've got that line of credit ready to use again, and then you can act quickly on the next property. And that's kind of how my wife and I ended up buying properties over the years. Just kept rolling that line of credit into other properties. We love tenants. We try to make nice places for them, but they technically are paying the payment for us by paying that rent, which hopefully covers the property taxes, the interest, and some of the maintenance, or maybe all of the maintenance.
So you mentioned cash flowing. Can you speak to that a little bit on how you try to determine whether something's going to cash flow and make sense for somebody?
Great question. Yeah, and it's an interesting process. Zillow has now they not only have their price estimate, but called Zestimate, but they put out rent estimates, and that's one factor that we look at. We also look at a percentage of the value. We try to look at the location to determine if it's a location that might get a premium amount of rent. That's why we named our company Location Properties, for that old cliche of location, location. And so we help property owners try to determine what the rent might be, and then that helps them determine, what price they might want to pay for that property.
Absolutely.
And so it's, I'll talk about it a little bit more later, but you don't necessarily have to have a lot of cash flow at first if you buy a nice property. I personally prefer the nicer properties that don't have much maintenance. A lot of investors, if they look at a property and it has a great rate of return, or what they might call a cap rate if it's a multi-unit property, sometimes the ones with the best rate of return have not been maintained in many years. That's how they made that rate of return so high. There's a lot of deferred maintenance. And so I see a lot of canceled sales on multifamily property once they dig into the deferred maintenance. They thought it had a great cash flow at first, but they did their due diligence and found out it maybe for the prior investor who did no maintenance on the property, they had a good rate of return. But now that the property actually needs to be updated, the new investor might not have a great rate of return unless they negotiate some of those repairs up front.
Which a lot of investors, they should have those maintenance logs, right? That they kind of hand over.
That is a good point. A lot of sellers, even some local attorneys who advise local investors, their seller's disclosure will have nothing on it. And then the answer to that is, well, wait a minute, you filed a tax return, and on your tax return, I think it's the Schedule E, it shows all your expenses and maintenance that you were willing to tell the IRS. So you should probably be willing to disclose that to any potential buyer.
And legally, you're supposed to disclose that.
That's right. That's right. Exactly. And so if I'm the listing agent and I see a disclosure like that, I go back to the seller and say, hey, I know you don't remember much, but let's at least put on there what you know and what the management company knows. And so that's another thing I run into as a management company is we're often advising the listing agent, saying, hey, here's everything that was repaired over the last 5 years. A lot of it's good news, too. New hot water heater, new roof, new flooring.
A roof is
new
huge right now.
Yes. A lot of roofs being replaced right now with all the storms. And so a lot of realtors, their closings are dependent on waiting on that roof claim right now. So we're seeing that quite a bit. Storm or wind or hail. And
that's due to insurance not wanting to cover as much with roofing items.
I'm finding some insurance companies are, if there's just a little bit of hail damage, they're paying for a whole new roof. Others are saying it's pre-existing and not paying. So it's
kind of dependent.
As a realtor, you kind of have to wait that out.
Yeah, just kind of see what they say.
Yeah, not promise a new roof till you know for sure.
So you kind of hit on this on what somebody should consider. Obviously, you mentioned location. Are there some other big factors that they should consider?
Yeah, there is, and most of them. And I've had this conversation with a lot of our investors that are just coming in to maybe buy their first or second investment property. And for them, my advice is buy a single family home. A 1-unit property. It might have a yard. tenants love yards. It probably has a driveway where they can park, probably has a garage they can put their vehicle in or store their stuff. And so I would look for a house with a garage, preferably a backyard, even better, a fenced backyard. Those rent out first. All the properties we manage, the homes with fenced backyards rent first. They just seem to be most popular. And so yeah, that's my first advice. And I think I'll touch on this later too. We do get some that want to go big and go buy the property right next to campus, and they want to be a part of the University of Kansas. They graduated from there maybe, and they want to tell their friends they own a place next to the football stadium or something like that. And so we get those investors too, and we do try to tell them, those have students in them. Those students might be living in a home for their first time ever. They all don't vacuum. We see a lot of vacuum packages still there when they move out that were never opened. So there's some issues.
A lot of those rent per room versus just the unit. I mean, the whole house itself.
That's right.
So,
yeah, a lot of investors that are kind of specialize in that type of house. They have a per room rate, and they make them pretty nice and somewhat indestructible. They'll
indestructible.
You're right.
With student housing, indestructive.
That's right. They'll seal up the floor with lacquer, half an inch thick, and vinyl plank flooring that can't be destroyed too bad.
Yeah,
a lot of them are getting rid of carpet. A lot of our landlords are tired of replacing carpet pad and carpet, so they're going to the luxury vinyl plank. And
that's probably pretty throughout. I mean, not just in student housing.
Good point. Yeah, that's definitely a nice trend. And as long as they buy, the type that holds up, might have the rubber base, waterproof base. Those tend to hold up well in rentals. And so that's one thing. One question is, do you buy a property that's already rented, or do you buy a house that's just on the market vacant, where you find your own tenants? And really, there's benefits to both. If you buy a property that's already got a tenant in it, then you can already count that cash flow. Probably when you get your loan, you can count that, I think 75% of that rental income towards your purchase of the property. Where if you buy it vacant, your lender's just going to rely on your other income to qualify for that property. And so we've had people do both. We've got some people right now that are buying a 4-unit building that's already got tenants in it, and so that's going to be nice for them that they already have instant cash flow when they close on the property. But we've also had some success stories where investor bought a nice home that had previously been an owner-occupied home, and a lot of times those sellers say, "I don't want to sell to a landlord. I want to respect my neighbors." But most of the people we manage for, and our management company, including the maintenance team, they try to maintain it like it's an owner-occupied house. So a lot of times the neighbors never know it's a rental.
Yeah.
And the tenants don't want their neighbors to necessarily know they're renters. Yeah. They want to, be a part of the neighborhood and not have people know whether they rent or own.
That's a good point.
So yeah. And Lawrence is over 50% tenants now. So
wow.
So more than half of the occupants in Lawrence rent. So there needs to be some housing for them to rent, not just apartments, but nice homes too.
Absolutely.
And I will say with financing too, if you can now qualify off of a lease, so if it isn't already being rented out, if you have somebody lined up that can lease and you show that lease to the lender, you can qualify off of 75% of that income.
Nice. That's good to know.
So that can really help out with that.
That's a good point.
Yeah.
As property managers, a lot of times we get that urgent message from the property owner, I need all the leases today. And we know what they're doing. They're refinancing. And so the lender just asks for all copies of all the leases. And so we keep those, of course, scanned in so we can just send them right out. But yeah, that's a nice way for people to be able to either buy or refinance. And
So speaking on leases, if they're buying a pre-existing home that already has a tenant and that tenant's going to be staying, do they have the right to do a new lease, or is that something that kind of stays until the end of that lease date?
Great question. Yeah, the tenant has the right to keep that lease as it is. And so the new owner can't change that lease. They inherit that lease or get it assigned to them. And so that when we start showing investment property for sale, and as a matter of fact, right after this meeting, I've got to go give 2 4-plexes notice that we have showings on Friday. And what I always add to that notice is, by the way, whomever buys it, your lease will stay the same. So that the tenants see that showing notice and they think, oh no, I'm going to get kicked out. But that's not the case. The not only does the new investor want the cash flow and want to keep them, but landlord-tenant law doesn't allow you to change a lease contract just because you sold it.
Yeah.
So now what could happen is the new owner may or may not renew the next year. They may offer new renewal terms. They may offer the same, but a lot of properties that come on the market, maybe the landlords were too nice, kept the rent too low, and now the market's higher. So the new investors, just to pay the mortgage, have to raise the rent.
You have to raise it.
Which is not fun news for us to have to give people.
Good to say that to them. And I mean, something else that people could be worried about too is, do I have to pay another deposit? New person, but they don't realize that the deposit is transferred at the time of closing.
Great question.
And
when our investors are selling as property managers, we usually help add to that closing statement, which is the lease proration or the rent proration, and then the security deposit. Or if we continue to manage it for the new owner, we just transfer the deposit within our books and don't send it to the closing and back, because it just comes back to the same place. But if it's selling to someone who's going to self-manage, we send the deposit, and then that new owner reconciles the deposit when the tenant moves out.
Yeah, and that way the tenant doesn't have to worry about that, which is, a lot of money to forfeit at multiple times. So,
a lot of times we still get the call at the end of their lease saying, hey, you have the check-in photos and check-in report, because we're working with our deposit now, and we keep those. So
that's good.
Yeah.
Well, too, so I mean, kind of getting to the financing side, I mean, we already kind of started touching on it a little bit. Mm-hmm. So, I mean, going into different types of loans for investors, what is the type of loan that you have had the most success with when working with investors or being an investor yourself?
Yeah, great question. And a lot of new investors talk to me. They said, should I form an LLC? Should I buy it individually? What should I do? And I technically have to say I'm not an attorney or a CPA. You got to go talk to your experts. But what I've seen work the best is if they just buy it as an individual. As a lender, you're probably giving them an individual rate that's lower than if they were an LLC. And then they can probably put less down if they're buying it as an individual. And so what we see a lot of people do is buy their first anywhere. It used to be they could buy up to 10 properties that were Fannie or Freddie Mae backed.
Yeah.
Is that still the case?
Mm-hmm.
Yes. For a while there, it dropped down to 3. And so some of our investors, when they got their 4th, got the news that, you can't get another Fannie Mae or Freddie Mac backed loan. You have to go get a commercial loan or
non-qualified mortgage.
Yeah.
So, I mean, right now, what's really popular with investors are DSCR, which is a debt service coverage ratio.
Oh, okay.
So instead of being qualified off of the income that they actually have, they get qualified off of it. So I have the actual formula up here so I can say it correctly.
Oh, nice. Yeah, that's perfect.
They get qualified off of the net operating income.
Great.
Divided by what the mortgage payment would actually be. So then they have their actual debt ratio. And there are different lenders that are offering this, and you can qualify off of different ratios. So, I mean, it really is dependent on that. But
Good.
I mean,
and then those don't get sold to the secondary market then, or do they still?
So some will sell it to the secondary market, some won't, but it's a non-qualified mortgage, so it's not backed by Fannie or Freddie.
Oh, okay.
So it doesn't necessarily have those same guidelines necessarily. Cool. So It's a new kind of upcoming loan. It's been around, but it's now starting to be more popular.
Yeah, that's great.
But I mean, with Fannie, Freddie, I mean, minimum down payment is 15%. Most of the time, gift funds aren't allowed, but there are special programs now where you can have gift funds. So just talk to a lender about that and just see, like, can I have somebody offer gift funds? Because a lot of times you can't.
Okay.
But there are some programs where they will allow up to a certain amount.
Yeah,
so
great.
Usually that would be maybe a community bank, or some brokers can offer that. I know I think only one of my lenders offers that. But, and then sometimes you can close in an LLC and have it not affect it. But I mean, if you're putting down 15%, the minimum, then your pricing might be more, and because it's just a higher risk.
Okay, so a little bit higher rate.
Yeah, and or it'll just cost some money to have that rate. And I mean, a lot of people don't think about that. And it's like, if you put down 25%, you might even be getting a credit back. So why put down 15%, pay a little bit for that rate, instead of using that money to just put additional down and then maybe even get a little bit of a credit back. So that's just something to consider too. But if you don't have that money and you want to get an investment property and want to just get into the home, start using that to help with affordable living, then by all means, 15% down.
Yeah, that's great. That's great. Yeah, and we've had some people get creative where they'll get a 1-year loan and then fix the place up a little bit. Doesn't have to be a major renovation, but just the upgrades we're seeing on houses for sale, flooring, appliances, fixing up the yard. That's one of my things that I'm recommending to a lot of investors is if you want your house to fit into the neighborhood, go ahead and treat for the dandelions and treat for some of the lawn things that a homeowner would do. That way your home looks like the other homes in the neighborhood. Just things like that. Once you've done those repairs, then you can go back to your lender, get a new appraisal, and then sometimes cash out. We've had one investor in the past year buy a kind of a junky duplex from a longtime local property owner who just didn't do any maintenance on his properties. After he bought it and had us manage it, we just fixed it up over time with the same tenants in there. The tenants were very cooperative to let us fix it up while they lived there. But then when they non-renewed their lease, we were able to jump the rent way up. And then that owner went back to his lender, got a great new loan, much higher appraisal, and then cashed out. And then his return is basically infinite at that point because he's got his down payment back and still cash flowing on that property.
Awesome.
Yeah.
And so he's since rolled that into another duplex that kind of doing the same thing, another kind of fixer-upper duplex. We tend to recommend slight fixer-uppers, not major renovations. But that still helps. You've probably seen some people come back with a new appraisal and it jumped in value, maybe catch it at a better time of the year where the market's up and that helps people.
And I mean, a lot of times people don't even realize that 12 months is what you have to wait in order to be able to use that new value with an appraisal. So, I mean, if you just make all these renovations and you're trying to refinance within 6 months, I mean, we still most of the time have to use that old appraisal, that old value that you had if you're the same owner. So a lot of people don't think about that too.
That's a good point. So waiting a year is the key or longer. Yeah.
Or, I mean, if you are doing like a fix and flip or something like that, I know this is a different episode topic. I mean, sometimes you even have to get 2 appraisals to go through all of that as well, to just make sure that all the values there and everything like that. So just being aware of that. But
yeah, good point.
We also kind of touched on this a little bit too, is using the equity to buy another home. A lot of people don't think of their primary residence or their home in general as a bank account. And a lot of people don't realize how much cash they actually have tied into their home that can be used for other things to help with affordable living, affordable housing, different things like that.
Yeah, they paid down their loan, and so they have more equity than they think. And it's gone up, especially in recent years in Lawrence.
Value,
Everybody's complaining about their tax appraisals they just got, but what that really means is they've got equity they could use if they want to. So
absolutely.
Yeah.
And I mean, it could help pay down debt, and that could also help with their bills and other things like that. So, I mean, just being able to use that and even purchasing that investment property to help pay for even more bills or expand their portfolio and just not have all their eggs in one basket.
Yeah, good point. One thing to remember on that, I've had people do this too. When you do sell that primary home, they do make you pay off that home equity line of credit.
Yes.
We've had some buyers that said, I didn't want to pay that off. I wanted to keep using it, but you can't use your line of credit on a property you don't own anymore. So another reason to keep the property and not resell it. But,
and then if they're stating that it's their primary residence, how long do they have to live there before they can
I'll defer to the lenders on that, but I hear it's 1 year, but I'm not 100% sure.
So technically 1 year, but I know that on your tax returns, and again, I'm not an accountant, not a CPA, you have to live in a home for longer than 6 months in order to consider it your primary residence. So a lot of times we're going off of the tax returns, but do not commit mortgage fraud.
Exactly.
Do not do that.
I tell people that all the time. If they want to rent out their current home, if they haven't lived there at least a year, I say, call your lender, see if that's going to cause some problems. Does it call the loan? Do you have to pay it off in full? Are they going to let you just keep making your payments? And they call that lender and get the news on that. Most of the time, they call me back and say they said I could rent it out and just keep making the payments and no no
I was
issue.
thinking
Yeah.
it was 2 years, but I could be wrong in that.
That's
thought.
good to double
let-
check.
let-
Good
yeah,
to
let's-
Yeah, we'll double
that.
check.
I'll double check
We'll fact
that
check
right
that
now.
one.
Fact
Sounds
check
good.
that.
Yeah. And while you're checking that, another thing I've had people do is buy a multi-unit property and live in it. And
Yeah, that's a good
think
point.
Yeah. And you see people as a lender, do that, and then you get a lower down payment. But one couple in particular bought a triplex. They lived in one of the 3 units. I think they may have gotten an FHA loan, which might have been that 3 or 5% down. Maybe it was 10 with the 3 unit, but they
Rented out the other two.
they did, so that the other 2 rents covered their mortgage.
It's awesome.
They did have to live next to tenants, so hopefully
Yeah.
they were good neighbors. A lot of times tenants are great neighbors,
Yes.
especially if you screen them and make sure
Go
that
through the
they have a
protocols.
good background. Yeah,
Yeah.
check criminal credit background.
Mm-hmm.
And last I heard from them, they said it was a good experience and it worked well for them. So,
Yeah.
Wonderful.
So yeah.
I mean, I've done a couple different FHA loans for investment properties too. I mean, especially with the duplex thing. I mean, it's been great.
Mhm.
But yes, so for FHA loans, just 1 year.
1 year. Okay.
And then, but definitely double check on your mortgage terms, just when you're talking to your lender, if you want that in the future as well.
I think it was something with capital gains.
Yeah. So capital
good
gains,
point.
that's
Good
it.
point, too.
Yeah.
Yeah. But I mean,
Okay.
there's different tax implications. So at least 2 of the last 5 years for capital
That's it.
gains.
Yeah.
Yeah.
That's a good
That's
point.
what it
Yeah,
was.
for their personal residence.
Yeah.
Yeah,
So definitely consult a tax professional
Yes.
on that if you are wanting to do that. But if you don't want to pay capital gains tax, 2 years.
Yep.
If you don't want to commit mortgage fraud, 1 year.
Good point.
But once
Good
again,
point. Yeah, good point.
make sure you reach out to those people that are 100% certified
Those
to
experts.
give you
yes.
those.
Defer to
Yeah.
those experts.
Yes.
Yeah.
So for managing a investment property, I mean, what tips do you have for those people that maybe just can't even afford like having management property or management service help them because it's maybe just one property and they're like, oh, I can do it.
Yeah, good
Yeah.
point. And a lot of people do start out managing their own property, and for some, it's kind of fun. They get to tinker around with the property, do the repairs, maybe do some of the mowing. We have some people that come to us who had been doing that 5, 10, 15. We just had one client. He'd been self-managing for 30 years.
Wow.
But after those 30 years, they came in and said, you know what, we're ready to turn some of that over
Yeah.
to management. And so yeah, people enjoy it. I encourage people to self-manage if they want to. Usually they call us either when they've had an issue that they're tired of. We had maybe one bad tenant or one non-paying tenant or an issue that finding repair people right now is difficult. So that's a factor. We have 7 dedicated maintenance people that can get there same day or next day, where most individuals can't find that responsive of a maintenance person. So that's a factor. A lot of times they'll just say, hey, I'm ready to travel, and I don't want to be getting those phone calls about the maintenance or about the tenants, or I don't even want to, they don't even want to show the properties anymore. They're like, I'm going to be gone during the summer, and that's when the tenants are moving in and out or whatever. So I encourage people to self-manage until they don't want to anymore, or they move away. A lot of people that we managed for have moved to other states. Jobs took them elsewhere.
Or they're elsewhere and
Yeah.
want that, rental property
Good
in
point.
Lawrence because they had ties previously.
Great.
So
Very good point. Almost all of our investors either went to KU, played sports at KU, or they had a kid that went to KU. I'm amazed at how many people just bring their kid to student orientation. They're like, I kind of like it here. I'm gonna buy a property.
Yeah.
And I always joke because a lot of my friends that have moved away and come back, or people like that who discover Lawrence while showing their KU kid around, I joke that I figured that out on day one. I've been here my whole life,
Yeah.
55 years. So they're jealous that I figured out Lawrence is a great place a lot longer than they did, a lot earlier than they did. But yeah, so that's a great thing with KU being here in Lawrence too. It makes for the investment properties to have a constant flow of potential tenants, and then as management company, we have a constant flow of potential people who need management.
yeah.
One couple in particular that we manage for, they're traveling the United States in an RV now. They don't have to maintain their properties anymore. They don't have to do the check-ins or check-outs. they literally just periodically give us a new PO box for their stuff or for their mailings. So we try to do everything by email with them, and most people, and electronic deposit their money, and they're seeing the United States. So while their rental property pays for their lifestyle, so we're seeing that, and it's kind of fun. We send checks to almost all 50 states now to different property owners, and some in Hawaii, some in Puerto Rico, some in Texas, some in Florida. Some in other countries. Some have moved to New Zealand. We're sending money to property owners all over the place, even though they own property here in the Lawrence, Kansas area. So
gives people financial, flexibility on what they can do later on in life.
Does. So it's fun to see that, and then we see the kind of back to what my dad advised people: buy a few properties every few years. You build up that wealth, and then some people are either leaving that to their family, they're putting it in a trust, putting it in an LLC. We've got one guy who's a grandpa. He's using his rental income to pay his kids' room and board at college. Wow. So literally, he will call on the first of the month and say the name of his grandkid and say, hey, the rent came in for his granddaughter to pay that rent for her. So it kind of flows to his account and then to her account. So,
awesome.
Yeah.
So people can use their real estate investment for a wide variety of things in the long term. So
yeah, I mean, I've heard people say, like, instead of doing 529 accounts for their kids' education or for their future, they're just buying houses and then just using it as investment, letting that equity grow and everything like that. And then either using it for them like that, or selling the home and then using that money that they've made on the home for the education or for whatever, or as a little nest egg for them. And so they can have a more affordable way of living.
That's a good point. We've had a lot of investors do exactly that, where they bought it for their college KU kid initially, and then a lot of times they'll find roommates. And what's funny is we have a few properties where even though the investor bought it and their kid lives in it, their kid still pays rent through us, and so do their roommates.
Yeah.
And so they make it a formal agreement,
yeah.
and then it seems fair to everybody because each roommate's paying the same amount of rent. Some of the money just happens to be going to one of the kids' parents because they're the investors. But then when those kids finish KU, a lot of times they just keep it as a rental. But if they sell it, they've probably appreciated enough to maybe even cover their college.
Yeah.
So,
what are some of the risks of owning an investment property?
Yeah, great question. And we see it all the time. We, like I said, manage over 500 properties, and each year of those 500 properties, only probably one or two end up having damages beyond the security deposit. So that's one risk: will a tenant do enough damage that it costs you more than the deposit? And that's pretty rare. So I'd say most of the time, 99% of the time, the tenants leave it in pretty good shape. Sometimes they leave it in better shape. They've fixed it up.
Because they want that deposit back.
They do.
It's so true.
We love and what's funny is we've added to our rental application, how often do you clean? That's just one of our questions.
Oh, that's
and
a
it's
good
kind of our
thing to think
tiebreaker.
about,
If the tenants have the same credit score and the how often do you clean is the tiebreaker.
Wow.
And we love those. They call themselves different things. Some say OCD. Some say they super cleaners. And the ones that say I clean every day, they might get approved before a tie with somebody else who doesn't clean as often, or if they say once a month or something. But those tenants, when they move out, it's spotless because they were already cleaning anyway. And so it looks good. And then it's ready for the next tenant, almost no turnover costs. The risks are the tenant that, and a lot of times it's the group of tenants. And so if there's major repairs needed to be done, it delays the new tenants from moving in, and that can cost some time and money for the investor. So that's a rare risk. An economic downturn is another risk, which, we had in that 2007, 8, and 9 period of time. That's actually when our property management company grew, because realtors all over town were saying, hey, property isn't selling, maybe try in the spring or something. And so some of them came to us and said, well, just rent the house out till I can sell it. And some of them rented it out for a while and then later sold it with their agent who referred to us. But some of them kept it as a rental, and it's still a rental. And so they've come to us and said, well, I'm so glad it didn't sell back in that downturn because it's since turned around and looking like a pretty good investment. So that's Other risks. One risk that I see a lot that a lot of people don't think about is people come into our office and say, "Hey, I'm partnering with my best friend. We're going to buy some properties together." And then I always say, I have to tell you, I've seen how this ends. And they look at me like, "What do you mean? Are you not excited about it?" And I'd say, I'd rather have you each buy a smaller property separately than buy an investment property together. And they look at me like I'm crazy because they're so excited about it. And the answer is I see that on the, 5, 10, 20, 30 years later, one of them passes away and then the other one owns half, the other one's estate owns half.
Yeah.
Or one person gets divorced and he has to cash out or she has to cash out, and then the other partner doesn't want to sell the property. So how do you value it and get the money out? Where if you own the property yourself, you control it. You can sell it, you can refinance it, you can make the quick decision on the repairs and rentals. So as a management company, our least favorite properties to manage are where there are 3 or more decision makers because they all partnered as friends. And it's hard to get a consensus on, do we approve that tenant? Do we replace the hot water heater now, even though it's not totally trashed yet? And so that's a risk is buying with other people. You don't know what's going to happen in their lives for the next 30 years. And
that's a good point. Or who they're going to leave things to as well. And then that's your new partner. And that's what people don't consider. Good point. I mean, there's a lot with that. That's a good point.
Yeah, we don't, we manage a few properties where, they're unintended partners is kind of what I call them. And one person might be 75 years old and now he's partners with a 30-year-old who inherited the property from his family who have since passed away. And that can get messy. I mean, we've had it work out okay too. We try our best to make it work out okay. And if they keep it, we can just, send each side their portion of the income. But when it comes time to renovating or doing something, it's tough to get a decision when they hardly even know each other anymore. So
that's a good point.
So in general, buy on your own. If it has to be something smaller, that's better than buying the big property with a bunch of friends. So they're usually not friends at the end of it.
Yeah, unfortunately, right?
Another risk.
Yes, that's right.
Yeah.
So,
do we want to get into fact or fiction?
Yeah, let's do it.
Yeah, sounds good. Sounds great.
So the first one, fact or fiction, multi-unit rentals are better than single-unit rentals.
That's a great question. And I would say it is fiction. For the most part, I personally, and some of that's my own personal preference along the lines of what I've said before, is the single units, the people stay longer. They've already made connections in the neighborhood. They might have that fenced backyard. They've got the garage that they've already put all their stuff in. Those single unit tenants stay a lot longer. So those property owners have little to no turnover costs, where those multi-unit buildings next to campus or next to the football stadium, like I talked about before, even though those are exciting to hear the roar of the football stadium in the background when they're on the deck, some of those people even rent out their backyards for parking. But those tenants move out at least every 4 or 5 years if they're on the 5-year KU plan. But more likely they move out every year or every 2 years.
More turnover.
Yeah, turnover, drywall, carpet, paint. And I love student rentals a lot of the times, but we don't always love their parents. So for an example, there's a 10-unit building right up there by campus. It's an old house converted into 10 units. And it does generate a lot of cash flow for the property owner. But every year, the moms of their kids who are moving in say the previous people didn't clean, and the house cleaner who cleaned in between didn't do a good enough job for their kids to move in. And then when the 5 to 10 kids move out, their parents are just sure their kids left it spotless, but then we do our inspection and they didn't. And so every year we have these kind of debates with parents of KU students about the condition. We usually work it out within a few $100s of what can be a few $1,000s of repairs or drywall. And in one case, the tenants wallpapered the wall with beer cases.
Naturally.
In their minds, they shouldn't have had any deduction from their security deposit for that. There were nail holes every few feet throughout that entire room where they nailed those on. But the tenants thought that was great. So I think ultimately we found a set of tenants that thought that was great wallpaper. But at first they didn't want to lose their deposit. But yeah, so back to that single family individual rentals tends to be the landlords or property owners, I should say, that own those seem to be the happiest, lower stress owners because they just get their cash flow and don't have to worry much about turnover. So
Less cooks in the kitchen.
So,
Less cooks in the kitchen.
Yeah.
So, and I guess I
kind of
answered
one,
student rentals. We kind of covered that. Yeah.
So how about don't buy a property if it has no positive cash flow?
Yeah, I would say fiction on that one as well. Some of our happiest property owners right now, the house they bought at the time, negative cash flowed. And we had somebody just buy one recently where really nice home, fit those guidelines I mentioned earlier with the backyard fence. Just the homeowner had left it meticulous. And so when you buy a house that's that nice, you're probably not getting a bargain. And he didn't get a bargain, but he got a good price. And right now, the rent is a little bit less than what the mortgage payment is on it. Although that guy got a 15-year loan, so he's paying it down quicker. So when you factor in, he's paying down the mortgage, and going to get the appreciation of a nice home in a nice neighborhood, even though he's not getting any cash flow. And I should say he and she, because it's a couple that bought it. They aren't getting any cash flow now. They will. And in a similar situation. Same thing, nice house here in Lawrence, out by elementary and junior high school, out by Sunflower and Southwest Elementary. When they bought it, once again, their payment was more than the rent, but just every few years we've raised the rent, or a reasonable amount, not to scare off tenants, and that rent just kept going up, and their payment stayed the same over that 15 or 30-year loan. I think once again that was a 15-year loan. And now they've almost paid off that 15-year loan, and they're cash flowing a whole bunch. And
it appreciates.
So no cash flow at first is okay if they can take the negative cash flow for a while. So
Yeah.
Should someone hire a management company right away?
Yeah, people who live in the same town as their rental don't necessarily have to because they're right there to maybe respond. But like I mentioned previously, sometimes they don't have the quick access to resources or maintenance people. But a lot of people like to manage their own property for a while, and a lot of people feel like they get to know the property better if they're doing the management or they're doing the check-ins or check-outs, and so they don't have to right away. It's worth investigating. We as a management company charge a small monthly fee, charge a small fee to find a tenant, and then they get the rest of the cash flow, other than maintenance. And so we like to think we're worth hiring, but a lot of times people don't right away. They do it themselves for a while. So I guess long answer is fiction. As much as I'd like to say they should.
You need to. Yeah, no.
One factor that's Lawrence has added is that rental licensing process now. In Lawrence, you got to buy a $15 rental license. You've got to have a local agent, and then you have to have an inspection.
Yes.
And so a lot of that has tipped some people over the edge of like, okay, I'm hiring a management company because that's just one more thing I have to attend in person, one more fee I have to remember to pay. And then, they find that there's not enough smoke detectors or not enough carbon monoxide detectors, or the window doesn't open. And then they need a management company to fix all that stuff. So,
and then each property needs its own license.
That's correct. Yeah. So City just switched to an online licensing platform. So we've got an employee that's part of her job is to make sure everybody's license is up to date. So
wonderful.
So it's kind of City of Lawrence has added to some of our work, but that's okay. Yeah. Part of the process. They're protecting people is what they're doing.
Make sure it's safe for tenants. So.
That's right. Yeah. That's right. So.
And last one, tenants tend to trash rental properties. Why was that such a tongue twister for you?
A lot of T's in there.
Yes.
But
Peter Pickle, whatever that thing is. Peter Piper Pickle, what is it? You know what I'm talking about?
I know what you're talking about, but I couldn't tell you what it
was. We might get into a Ron Burgundy situation if we keep trying that one.
All right, one more try here.
Yeah.
Tenants tend to trash rental properties.
And that is somewhat true on a small percentage. So I'd say overall it's fiction, because I think I mentioned it before. A lot of the people, they want their deposit back.
Yeah.
And I have that experience from when my kids went to KU and didn't stay in a place that we managed. I wanted them to get their deposit back. So I kind of helped them make sure they cleaned it up in a way that a person doing the checkout report would be happy with. So since we are often the people doing the checkout report. But yeah, of the 500 properties we manage, it's just a few each year that where they're and I wouldn't even say trashed. It's more damaged beyond their deposit. And so I'm finding that a lot of times they're willing to. They know they did the damage, and they know their deposit's getting applied to that. Sometimes they're relieved that only their deposit is getting applied to that. But if it exceeds the deposit, we send them an invoice and have the collection process available and let them know that, and they usually pay. Not always, but so as a property owner, the risk gets minimized by that security deposit, and then by the tenants knowing they might get a collection action against them. And if you get a judgment against a tenant, someday they're going to apply for a car loan or a house loan, and they'll have to pay that judgment in order to move forward with their lives. And so property owners tend to ultimately get their money. We do once in a while get a property owner that says, "Oh, I know it's been 15 years, but I want to charge that tenant for new carpet." We advise them that they can't do that. We're like, it's depreciated down to zero. As the property owner, you're buying new carpet. Mm-hmm. That's normal wear and tear. Tenants don't get charged for that. So we try to be fair to the tenants, but
well, that's part of having a management company, right? To tell you those things of the life of carpet and how long that lasts and things like that an individual might not know. So.
Very good point. Yeah. And then, then pets are a factor too. Do you allow pets? And we tend to recommend that property owners allow pets, but allow pet owners that are good caretakers of their pets. So we've got a way to kind of try to determine that ahead of time. And charge a little bit more security deposit as a pet deposit. So.
Yeah.
And kind of backing up a little bit to something you said, if a judgment or collection is placed on someone and an individual, that does affect your credit.
Yes.
I do just want to say that does affect your credit.
Good point.
Yep.
Yeah.
So be aware
it comes
of that.
up on credit reports.
Yes.
And speaking of credit, one thing we're seeing a lot lately, and it might be the Dave Ramsey effect, is we're seeing people apply with no credit score.
Yeah.
And so they're proud of that because they've been paying cash for everything. And so they haven't had to borrow money or get a credit card. But that hurts us in our decision-making process. So we recommend people go to those websites that tell you how to build a positive credit score. Go to annualcreditreport.com.
Or a local lender who might be able to tell you.
Yes, good point. Yeah. And just at least get a credit card with a small balance and pay it off every month. And then that way they've got a credit score. We've had some good applicants, but then our software that does the credit and background check everything's gone to AI now. It has an AI score, and it doesn't have a good score if they can't even find any credit for that person.
Yeah.
And so I recommend people build their credit by just having a small credit card or pay their car loan on time or early. Some landlords, including us now, and I should say property management companies and property owners, we can report to the credit bureaus on-time rent payments. So because we collect rent online, they have a little button they can click, and it's tenant decision. They can make the decision to click, yes, I want my rent payments reported to credit bureaus, and then that gets reported as on-time payments every month. So
you can also self-report utility bills as well.
Oh, good point.
So a lot of people will do that, and that's an alternative credit method. And then another way is you can go out to a credit union or something, get a small personal loan, even if it's just for 6 months.
That's a great
And
idea.
then pay that back each month. And then that really does build your credit pretty quickly.
Yeah. And, as realtors, we have to take our continuing education every 2 years, 12 hours. And last year I took one on building credit score. And I was amazed at all the details that you can do to improve your credit score like that. And make extra payments. If you can make 2 payments on your credit card, do it, just to build up those recent payments.
Yeah.
Try to pay it off every once in a while so it shows balance paid in full.
Yeah.
Don't let it go more than 30 days. Otherwise, that gets reported as well. So,
well, and is there a way for somebody who still just really doesn't want to build that credit, is comfortable with having a zero credit? Do you guys do something else, like maybe check history?
Great question. Yeah. As a matter of fact, our property management team is actually meeting on that this week because we've had more and more of those. Either their parents were the no loan Dave Ramsey people, or the kids just haven't had time to go get credit yet.
Yeah.
And so, we're talking about co-signers, checking their, we do this anyway, but see if they've got a job or if they're a student, are their scholarships paying for everything. And so we try to have alternative ways to determine their qualifications. But really, if they're going against somebody with the 750 credit score, we're probably picking the tenant with the 750 credit score over the tenant with no credit history.
Yeah.
Just because there's a clear track record of them being responsible with their payments. And as much as no credit might be good because they didn't ever have to borrow, there's just no
history there.
No history, no track record to look at. So sometimes we get some tenants, kind of applicants, upset with us if they didn't get approved. A lot of times it's because somebody else just had a better credit score that applied at the same time.
Yeah. I'm just going to go through some other fact or fiction really quick.
Sure.
And but I'm just going to answer them really fast.
That'd be great.
Just so we can, since it's, we kind of got like on so much good information and talking about, I feel like for the affordability, we just need to say them just really quick.
Sure.
Yep.
So, for a investment property, you can buy an investment property with as little as 3% down. That's fiction. Minimum is 15%. We kind of talked about that earlier.
Good to know. Yeah. On that FHA program, can they live in it, or do they still have to put 15%
You have to live
down?
in it, and use part of it as your primary residence.
Okay, with 15% down.
With 3.5% down.
Oh,
so
okay.
You can live in one side and then rent out the other side. And you wouldn't have to put down 15% because technically it would be your primary residence.
Good point. Okay.
But if it's just an investment property, then 15% is the minimum. Then you can use the projected rental income from an investment property to help qualify for a mortgage. That is a fact. So we will use a percentage of that to help qualify. You do not have to be an experienced real estate investor to buy an investment property. You can be a first-time investor. There are different programs for that. Just talk to a local lender about that. And then investing,
It's important to note that you're not going to go out and buy 5 at a time like we mentioned earlier. You're going to build that over time. So that's necessary. Yeah. People aren't going to have the money to be able to go do 5. So.
Yeah, most don't. Every once in a while we have a fortunate person who maybe lived in California for the last 25 years and sold that house there. Yeah. And sometimes they can buy 3 to 5 here for the price of what they sold in California or wherever the market just went really high. Yeah, but not very often.
Yeah. And then also investing in real estate is only profitable in urban areas. That is fiction. Mm-hmm. So even though we have higher rental demand in urban areas, properties in suburban and rural can also be profitable as well.
Yeah, in real estate, we see people specifically looking for some rural properties to rent too, that they want to be out, kind of have some land and
we manage only a few out on some land, a couple acres here and there, and those tenants tend to stay because they love it. They love living out on some land. Yeah.
Wonderful.
Sweet. Is there anything else you want to add?
Let's see. I think we covered a lot of the topics I kind of had in mind coming into this. Yeah, it's I think we covered about everything. Really, it's a way to. A lot of times people say get rich slowly. We're owning an investment property. You're paying down a little bit of principal every month. You're getting a little bit of appreciation every month. You getting some tax deductions. You're just kind of gradually building up that wealth, almost to the point of where you don't even notice it till you do your tax return at the end of the year, and you're like, oh, wow, it went up in value. I've paid my loan down, and wow, the difference is quite a bit now. And during that time, the tenant helped you pay that payment. And so it's a good, just long-term way to build wealth. And you probably hear this a lot. People will drive by either their old home when they were a kid or a house they previously owned, and they'll say, I wish I would have just kept that house. It's worth like 3 times now what it was when I last looked at it. And so that's what some of these people are doing by just keeping the property, is they are going to, 20 years from now say, I'm glad I kept that house rather than I wish I would have kept that house. So.
Yeah. Well, and one thing to note, with somebody buying investment properties, they are helping affordability within Lawrence because they give tenants a place to live that's affordable, because not everyone can afford to go out and purchase their first home. And so that allows them to build their wealth as a tenant as well by, paying their rent and then looking for something later on while they're saving some money. So
great point. Yeah. Good point for sure. Yeah.
Great. Well, thanks so much for coming out.
We're really appreciative of your time.
I appreciate it. Thank you. I appreciate all the good topics.
And thank you to the Lawrence Public Library for letting us use this space. We're very appreciative to have this.
It's amazing. Yeah.
Sweet. Okay. Signing off.
Thanks for joining us on Lawrence Real and Local, Keepin It Real podcast. We appreciate our guests taking the time to join us. Don't forget to subscribe and leave a review if you've enjoyed today's episode.
For more information, please visit us on the web, www.lawrencerealtor.com. And remember, whether you're buying, selling, or simply dreaming of your future home, we're here to help. Until next time, keep it real
And happy house hunting.